Friends, let me just take you, before I take you to my subject matter, let me just run it over. Can you pass it? Let me just take you the background of MLI in a brief. How MLI was conceived, how does it work, basically, just for a few minutes. MLI is a very unique instrument which was developed by OECD to prevent base erosion profit shifting, and it will enable the signatories to implement BEPS and change the treaties supposedly in one stroke. I've used the word supposedly in one stroke very carefully. The concept of MLI was one negotiations, one signature, one ratification. MLI operates on the principle of mutuality. It means that the provisions of a bilateral treaty will only be applied if both the jurisdictions agree, and the entire edifice of whole negotiation of BEPS model has rested when both the jurisdictions have to agree before any article is implemented. What is the BEPS goal? The BEPS goal had always the goal of revising the international treaty framework so that it is aligned to the developments in the global economy, change in the business model, intricacies of the business model, size of the businesses, so that the profits are taxed where the economic activities are located and where the value is created. India signed the MLI 2 years back in June 2017 in Paris, where it published a provisional list. Let me repeat the word, provisional list of notifications and reservations, and listed 93 out of its 94 treaties which it intended to be covered by MLI and which need to be modified. So India wanted that 93 out of 94 treaty should be amended by virtue of this. Subsequently, after this, before you make it effective, 2 years after that, in June of 2019, the India deposited the definitive, from provisional to definitive list in June 2019. So there are 89 countries basically which have signed the MLI. 29 have ratified it. Give me a number here or there. Which they've deposited the instrument by June of 2019, and 29 countries have listed 22 out of them as India as a part of the treaty, where they intend to amend the India treaty with them out of these 29 countries. And each MLI, when you sign a MLI, you have to notify that time the bilateral treaties which you are desirous of amending it through MLI. And these treaties which you intend amending are called Covered Tax Agreement, CTAs in the short form. So in a nutshell, MLI allows the government to modify the tax treaties in a synchronized manner without renegotiation of each treaties bilaterally. It will not function in the same way as in the past, where each protocol was amended individually, but will be applied. It will be applied alongside the existing treaties, modifying the application so that it is able to implement the BEPS measures. Once post is ratified, so it paves the way for the implementation of BEPS measures. And even when it is notified, the OECD gives you flexibility that you can still have certain reservations, you can withdraw the reservations, added there is all those flexibility still remains. So before I conclude this thing, a couple of more points. So India MLI position includes the following: the bilateral treaties which you're likely to amend, the reservations that you have made it in respective articles, and certain notifications. You have a choice. So you give a notification, I'm going to take this clause of the article, so you notify them. So basically the position of MLI consists of these three main heads actually. Just to let you know, there are 39 articles in MLI, out of which I just said 29 countries have agreed to amend it, have signed the ratification. And surprisingly, the developed countries like Australia, France, Japan, Netherlands, Singapore, United Kingdom, UAE, all have signed it as these becomes a part of 29 countries. So China was not a part of MLI, just to let you know, maybe because we had a treaty with them. Hong Kong has been included because we just concluded a bilateral treaty with them. Mauritius has agreed to be kept out of it. Very surprisingly, Mauritius has been from court's point of view, from Supreme Court judgment point of view, from substance point of view, India wanted Mauritius to be part of MLI, but Mauritius has refused. So they will deal each clauses with bilaterally, and today stands as it is. And United States said it is not a part of signatory to MLI, and they believe that the treaty network is robust enough to avoid treaty shopping and avoid exposure of BEPS. So friends, this was just a background. I have to come to my eminent panelist here, basically. And so what I said is there were 93 out of 94 treaties which India have agreed to modify them. There are a lot of countries like Norway and other countries where they have not signed so many treaties as they wanted to amend it. There are countries which have done 80-90%. India did 98% of the treaties. Why India took such an aggressive position of amending all the treaties? So my first question, sir, to Rasmi sir, to you is, sir, when India listed 93 out of 94, 95 treaties, does all these treaties needed amendment? Does all the treaties had some base erosion so much that we decided to amend all the treaties at one go, basically? And that took close to 98 to 100%. Very few countries have done it. Why India took a position, I believe is a very aggressive position, amending all the treaties. All the treaties are weak.
Thank you.
Closer to the mic. Closer to you. Yes.
Yes. It's true that out of, say, around 95, I should say 94 treaties, 95th treaty is a treaty between private associations, India and Taipei, which has been notified. But the China treaty, since we are negotiating with China at that point of time, so most of these provisions were by that known, so most of these provisions are already in the treaty as agreed between India and China, which has been notified now. So we notified the balance all 93 treaties. Now, it doesn't mean that all 93 treaties are required to be modified in every respect. But definitely there are one thing or the other with each treaty that we thought it requires to be modified, and that's why we chose. And I don't think it's, you can call it an aggressive stand, because if you look at this, out of these 93 treaty partners, except 5, Switzerland, Oman, Mexico, and a couple of others, 88 treaty partners also agreed with us that their treaty with India requires change. So not only we, 88 of our treaty partners also felt that the treaty requires change, and they also put India as their treaty with India as the covered tax agreement. So it doesn't necessarily mean that all treaties will, as I said, require to be modified in all respects. For example, MAP. MAP is a minimum standard. Almost 80 treaties had a MAP provision, but we required some changes in respect of couple of, maybe a treaty like UK where it didn't have a time limit of 3 years, or maybe a treaty with Belgium and Canada where a time limit of 2 years to be extended to 3 years. So that way, that part only will change. Mostly, but in Indian treaties, we never had, in most cases, the preamble. And that preamble will now apply to most of our treaties. That's the reason as to why we went for the 93 treaties.
And Navin, you're from the industry, basically. When we changed 93 treaties at a stroke, or where we intended to, basically, that's the right word, do you think from tax point of view, are we making it difficult for business point of view? Do you feel the business becomes, because tax is a cost today, basically. Do you think from tax point of view, it is really a deterrent step for you? You feel major revamp in the international tax system or Indian treaties, actually, from business point of view?
Thanks for that question. Actually, I could relate to the theme of the conference, which is we live in the VUCA world, which is volatile, uncertain, complex. Wow. Now, I would like to talk about 2 or 3 facts. One is that India has adopted not only the minimum standards, but even the optional standards, virtually all of them, except for the detailed LOB and except for the arbitration. That MAP should not be subject to the arbitration. Now, the second thing is that, there were 240 billion was the initial estimate of the revenue leakage because of the BEPS measures being adopted by the multinational companies, and which was reflective in their effective tax rates. So the whole idea was how to address that. So it will be helpful to understand, through these initiatives, what kind of revenue we intend to gather. And in one of the previous communications or in one of the sessions, there was a number of 138 million on account of equalization levy. So how much we intend to gather through these, notifications and amendments. The third thing is currently India's rating in terms of ease of doing business is around 77. And the aspiration of the government is to make it 50. Now, as an industry, we welcome it because it leads to additional revenues. It helps in garnering more tax revenues, which is that money flows into the economy and consumption and business and everyone grows. What is my ask as a business? My ask as a business is, can you give us certainty? And there has been a number of changes. This is not one of the changes which has happened. It's just a part of it. For the last 3 or 5 years, there have been immense changes. Whether it is ICDS, whether it is GST, new tax law, BEPS, equalization levies, taxation of digital economies. So virtually, we are definitely living in a environment which is very, very uncertain. And how do I get certainty? So this is one ask. And how much money do you think it will contribute to the sector and towards the well-being? And how it's going to help us? So that's it.
So business point of view, you need certainty. From that point of view, it is welcome.
Absolutely. One
I
is
agree with you.
primarily if there are, when we come to the next parts, I would elaborate it on more. But some kind of guidance, like the tax ordinance came, so the guidance was MAT credit is not available. So industry may agree, may not agree, but there is a guidance that it is not available. So something like that.
Andrew, you being part of OECD, now such a massive exercise, going from last 7 years, I'm sure is going to continue for a good amount of time, Mr. Akhilesh Ranjan said in the morning, and I fully subscribe to his views, right? Has any estimation done, actually, Andrew? How much government, once it is implemented, what are the likelihood the taxes the government is going to earn? Some sort of thing to see we are working so much on it. What's the gain is coming to the government, likelihood gain to come to the government? Any estimation, wild guess?
It's a pity that your first question to me is one that I can't answer. When we were looking at this, we put out some estimates of the amount of tax that was going missing, if you like, because of BEPS strategies, and we put out 2 figures actually. The lower one was 100 billion, and then 240 billion was the higher one, and that was an estimate of the tax lost because of BEPS. So you can see that that's a pretty wide range. It's phenomenally difficult to try to find a reliable figure about the effect of all these measures. They don't all come in at once, and even if they were to, I think it would be ambitious to think that we would sort of plug every conceivable gap with the measures that we've got. But because they're coming in piecemeal over a period, not all countries have adopted them. The whole the shifting pattern of behaviours, the dynamic nature of it means that it would just be you'd be plucking a figure out of the air.
Was this estimate done in 2013? I have just been told, and today it will be much more higher.
Well, I dare say if we did the estimate, I don't know if we redid the estimates what the figure would be, but those are not. Those are figures that have been around a while.
So I was just told in the pre-panel discussion, it could be to $750 billion, like some sort of an estimate has come, which the government is likely or the government is losing money. It's a both way, basically. So it's a humongous, so that is absolutely right. We need to plug it, or the government needs to raise this money and tax this money.
I mean, I think you need to be cautious about using such very large figures, because this isn't just money that's lying around on the sidewalk that people can sort of come and pick up. It's money that's in the system, and if you sort of if you pick up money here, then you'll sort of lose money here. So it's unrealistic to think that there's somehow $750 billion that's just waiting to flow into countries' coffers, because there isn't.
I think one of the most debatable and litigated article in the whole treaties has been permanent establishment. Maximum litigated, government gets the maximum money when they create tax officials teach your income and create a PE for you. So basically, we are going to concentrate a lot on the permanent establishment because everybody sitting here, you are affected when you are in a business and you're a professional or from the industry, you're really worried about this article. So I'm going to concentrate on permanent establishment a lot, but it's different what we discussed in the morning session. And the three clauses which have been blatantly used or misused, abused, I do not know what is the right language we use, where things have been done to see that there was no permanent establishment created, and hence, because of that, a lot of companies did not create a P in India. And one was the main article which I'm going to discuss, which is article used to be erstwhile Article 5.5, and now it is Article 12, basically, and that was a commissioner arrangement where the foreign company used to have a dependent agent in India, and that dependent agent used to routinely work for the foreign companies, basically. And through this amendment, the broader definition agency PE has come in MLI, basically. And what India did it actually, India blindly accepted it. No change, no word, we accept it. So if anybody has created those structures and other jurisdictions have accepted the same position, have not reserved it, so this clause takes effect from 1st of April 2020. And if you have some businesses going on like that, you need to seriously look into that. And now, sir, I would like you to explain, sir, about the nuances of this. First of all, what was the change that they brought in this article from the erstwhile position to this position, sir? How it was being abused or misused earlier by the businesses by not creating a permanent establishment, and how change widens the definition of dependent PE, sir. To you, sir.
Thank you. I think what the MLI
Close to the mic, sir.
what the MLI wants attempts to do or to modify the treaty is, earlier we used to have the dependent agent P definition, where the definition was that it habitually concludes the contract. He has the authority to conclude the contract. So what used to happen is you have a marketing PE or market support services, the P providing the market support services, or a small office providing market support services, doing everything which are required to procure the contract. But finally, the contract getting just signed overseas. So that used to go out of the P definition. Now, those things will actually become P, and a proportion of the profit attributable to that activity which procures that order. Indian tax treaties also have a clause which says that if you procure an order also, that also creates a PE. But that will become very clear now, and that part will be attributed. The second thing that used to happen is that the contract was necessary to be in the name of the enterprise, which was providing the goods or providing the services in, let us say, in India. Now this expands it. Apart from the fact that the contract may be in the name of the enterprise, it will come within the definition of the PE if such contracts also provide the goods or provide the services which the enterprise is providing from abroad. So even if it is not in the name of the enterprise, but the goods and services are provided, so just creating a commission agent in between so that only the commission income gets taxed and no income from the sale of those items through the PE, the profit attributable to those transactions, now they will be under the new P definition. Those will attract tax.
So what is the, one of the changes, if I'm rightly correct me, sir, which has been come in MLI position is, if he plays a principal role leading to the conclusion of the contract, so then you create a dependent agent, you widen the definition like that, and on that related by Andrew to you is there. When you use these words principal related, they have a lot of subjectivity embedded in it. Will it lead to open doors for interpretation and dispute? And finally, does the principal rule means an exclusive rule?
Okay, well, the old rule was, as Rasmi's just explained, if you had a person who was habitually concluding contracts in the name of the enterprise, now that was all very clear. Well, up to a point it was very clear. We kind of know what the conclusion of a contract is. It's putting your name on a piece of paper. We should know what in the name of the enterprise is. I mean, does its name appear on the contract? But we thought, well, those sort of bright line tests are easy to sidestep for exactly the reasons that Rasmi explained. You just sort of, you not quite conclude a contract, and then you say to your client, oh, I'll just have to send this off to head office and they will rubber stamp it. I mean, consider it carefully. So this was the sort of the strategies that we were trying to adopt, and so that was the point that you're making about playing the principal role. So we said, okay, we don't want someone just doing that, sidestepping the conclusion of contracts. We want to enlarge it to say someone who plays the principal role. Now that is necessarily more vague than someone who's actually concluding contracts. Yeah. But you can't have, you can't do both things. If you've got a hard black letter rule, people find a way of stepping around it. Therefore, you sort of have a kind of a penumbra of meaning around this, around these terms. And it's just inevitable that you've got in a phrase like plays the principal role. Well, that is going to be the source of some dispute. There's no denying that.
That's not denying. So, friends, just to let you know, this clause comes in Indian MLI, effective from 1st of April 2020. So any such arrangements where you feel your businesses are there or you're advising to the client, you're clearly, and that other country has not made any reservation, it becomes implementable to you immediately from 1st April. Now, there's another clause which have been blatantly, actually, in my opinion, have been, again, misuse. I don't know whether I should use the word misuse or abuse, actually, I get confused, was of Article 5.4, actually. But a lot of activities were done there was an exemption under erstwhile Article 5.4, which was deemed to be called a preparatory and auxiliary in nature. So there were activity defined in 5.4, and a lot of actually being used in their favor. They used to say these are preparatory activity. You don't create a permanent establishment. There's a 5.4 exemption. They are coming under that. And hence there is to get a tax, no P, and hence no taxes were there basically on that. So what the government did it actually, as in the previous day, India again did exactly the same thing. What was there in MLI? Accepted one of the options, which is an option A actually. They had the choices. And they say, okay, yes, basically, such preparatory activity will only be treated preparatory if you are P&A activities. So earlier, a lot of activities you were doing it. Individually, they were not preparatory activities. But when you used to break them separately, they used to become a preparatory activities and used to claim a no P position. So what the government did, they did two things basically. There were no anti-fragmentation rules earlier, which they have created it now. And they said now you will only get the exemption if these activities are preparatory in nature. So now on these things, Andrew, I want to come to you on this thing basically. A lot of countries objected to this. India accepted it. Number of countries said, no, I'm not accepting it. What is there in the treaties, I'm not going to amend it. From you, what has been, is this, when so many countries make reservation, I'm not going to accept it, basically. What has been a global practice? Was this abused rampantly globally or was not abused at all, actually? Why so many countries like Belgium, Singapore, France have still made reservations, basically? And I'm actually really, it's baffling, actually, basically. Then why you had this clause, India accepted it, you don't accept it, this is not effective for me?
Well,
it nullifies my whole attempt of MLI.
You're right to say that if one country opts for that provision and another country does not, then it does not appear in that bilateral agreement because it has to be agreed. And it's worth just saying at this point maybe that the MLI respects the bilateral nature of tax treaties. So in a bilateral treaty, nothing happens unless both sides agree, and the MLI respects that. So it's always open to one party to say, no, I don't want to do that. I might be prepared to do it in a bilateral negotiation, but I'm not going to do it in the MLI. And that brings us back to the two things which you accurately described in the Article 5, Paragraph 4, the preparatory and auxiliary sort of exemptions. But even that phrase begs the question, because the traditional orthodox interpretation, at least the one held by the OECD, is that those exceptions are per se exceptions. So, for example, if you have a warehouse, then and you're using it just to store your stuff, display it, and deliver your stuff as an enterprise, then that is not a PE. There's no extra condition that it has to be preparatory or auxiliary in the old wording. But in the new wording, it does have to be a preparatory auxiliary for you to take advantage of that provision. But when I say take advantage of it, this rather, I don't want to suggest that the old provision was kind of an abuse. It wasn't. I mean, a country doesn't say, oh, I know, I want to sort of abuse the treaty, I'll open a warehouse. I mean, it opens a warehouse because it wants to sell its stuff. Now, it's a separate question whether that threshold was too high, and what we felt was that during, as part of the BEPS process, yes, we felt that was too high a threshold. And so in the OECD model now, you have a lower threshold. Now, why didn't people accept that in the MLI to the extent that they have? And I suspect it's because it wasn't particularly an abusive issue, and that people might have been prepared to accept it as part of a bilateral negotiation. But for those, if you like, capital exporting countries, they weren't just about to give up a unilateral reduction in their threshold. So that would have been the argument, if you had a country that hadn't accepted it, this is what they would be sitting here telling you. But a different consideration applies to the anti-fragmentation rule, because that is clearly an abusive behaviour if people are artificially fragmenting their activities among the different exemptions in paragraph 4 in order to take advantage of the exemptions. And you will find more countries accepted the anti-fragmentation rule in the MLI than accepted the preparatory and auxiliary overlay to paragraph 4.
So there's two messages for the audience here. One is this: again, India has accepted this position, it's a part of your treaty, and if other country has not made any reservation, it becomes implementable. So only those activities which are preparatory in nature will only have this specific exemption, otherwise you will create a P in India. Now there have been a lot of India decisions, judgments, jurisprudence on this thing. Neha, can you tell me something, some judgments, how the court has dealt, before even MLI, how the court has dealt with certain questions?
So Indian judiciary has always, this interpretation issue has been there as to what constitutes preparatory and auxiliary. And in case of Motorola, interestingly, many activities were listed as preparatory and auxiliary, and hence Motorola did not constitute P. And these activities were interestingly market survey, even furnishing product information, development of market opportunities, handling accounts and finance functions, ensuring distribution and warranty obligations. So these activities, if we look at today, in the current scenario, may not constitute preparatory and auxiliary, and will not be, these entities will end up constituting a permanent establishment in India. So I would say Indian judiciary till now has changed its state by constituting LO as a P when they conduct these kind of functions like market distribution and market survey, and preparatory auxiliary argument is no more available to these entities.
So even if you're storing a good, basically, like Andrew, you mentioned that you create a permanent establishment. Earlier you used to say it is a preparatory nature. Today it is not more anymore preparatory nature. They will constitute a PE. Am I right?
Well, that would be a facts and circumstance test according to whether it was a preparatory or auxiliary. But if the new provision is included into a bilateral treaty, then in order to take advantage of that shelter, if you like, that exemption, the activity would have to be preparatory or auxiliary. It would know, so the per se exemptions have been taken away.
Sir, for you, sir, one more thing. We want to know certain cases, specific cases, more specific cases. When this article is being amended, what was India's position? Why you really went to amend this thing? Just specific cases for my audience, actually, which you felt was being misused and has to be curbed by this MLA article, basically. And how this anti-fragmentation rule, which was not there, are likely to prevent it more. Will it be blatantly used? It will be used in related party, or what type of cases or thresholds are there?
No, as Andy was suggesting, there are two changes MLI does to the specific exemption part of the PE. The first one, there was interpretation issue. I think, as Andrew correctly said, most of the OECD countries and OECD commentary says that those activities which are listed from A to D in Article 5, those activities by themselves constitute an exemption, whereas India has always taken the stand from the beginning that those activities will be exempted from P provided they are preparatory and auxiliary in nature. I think we saw maybe some OECD countries also have accepted this, maybe Canada. there was, I think that's why, as Andrew was saying, it's fair that some countries feel that those activities per se, if there is, that you have a storage, you have a warehouse, no question of PE, whether it is preparatory or auxiliary in nature. That's one interpretation, which was not our interpretation. But with the change in MLI, that needs to be proved that it's preparatory and auxiliary. This is number one. Second is what you refer to as anti-fragmentation rule. Suppose you have a branch of a bank, you are processing loan applications. Now the processing of the loan application in one PE or one entity for a say foreign bank situated outside will constitute maybe a preparatory and auxiliary activities, support activities, basically back office operation. But if you have banking operations here, this will no longer be considered as separate. This will be hit by the anti-fragmentation rule, and the entire thing, including from the entity that is processing to the application to the bank branch, that will be part of the PE. So that way it is, this is necessary because from India's point of view with digitalization, there is a whole debate going on, and I don't want to go into that. But it is now possible for an enterprise to take orders, sale orders, conclude sale contracts, and then have a warehouse in your country. You don't need a store to sell those. You take orders online, and then you use the warehouse from where you just sell those products. And that is the reason as to why even, I don't know whether this definition or the changes will encompass those, but that is why something like Australia's law of multinational anti-avoidance law came up, where they said that if you have an enterprise storage facility, and if you regularly you employ someone to deliver those products to the customers for which the contracts are concluded abroad, that will constitute a P. So those are situations in the evolving situation of digitalization. Such fragmentation is quite possible. Businesses were using it. So to that extent, the anti-fragmentation would be possibly helpful to end such abusive behavior.
And Navin, you are in business now. From business point of view, do you believe these changes which are coming in MLI basically, do you think these genuine business structures you are working today in a certain fashion, 1st April 2020, everything changes? How do you feel it? Do you get stumped immediately by these articles, or are you going to remodel or reinvent yourself, or you are ready to pay the taxes and say, yes, you have a P in India?
No, that's a fair ask. But the only thing is not that all other countries are going to accept it. So you're going to get into a situation that some of the countries have accepted, and you will end up constituting a P. There are a lot of countries in which you will not constitute a P. Now, when it comes to a business partnering role, or when it comes to discussion with your supply chain team, or the team that manages the exports or that manages the imports, the question will come here is, can you give them a standard SOP? What is the general guidance you can issue to them? Now that becomes a very difficult part, because then you're managing moving pieces. And I really like the Rahul's Mitra's statement in the previous session, where he said, as a business, what is the kind of communication you want to have here with supply team? Whether there is a PE and how much attribution will happen, or whether there is no PE. And how you will like to structure your business. You would like your structure to your business to make sure that you don't end up constituting a PE, or you would like to structure your business to make a right attribution and pay the right taxes. Now that is something which is a challenge for a tax professional, particularly from an industry perspective, because what you have to struggle here is there is so much of activity in the business that all the time as a tax professional you're not connected to the business in real time. The employees move, the people move, you will end up engaging a third-party consultant in that country to advise you on the customers, for you to help conclude contracts. So yeah, the thresholds, the moment they become less and less, the risks for the business keeps on increasing. And if you have to be a compliant entity, your biggest struggle is how do you ensure that you pay the right taxes. So to me, the most important discussion as far as this goes here is, what is the attribution? How much will be the cost to my business? Does it make me competitive or uncompetitive in that country or in India, and how do I address that?
I think we'll go to the third article, which again, India accepted it. Actually, India was very generous, accepting all the 3 permanent establishment articles as it. They believed that less tax everywhere where we can do that. So this is a splitting of the contract actually, which was generally used in EPC contracts and oil and gas sector contracts, where there's a threshold of permanent establishment is there, and that threshold you used to defeat it by splitting your contract into different threshold, and none of those companies or entities used to constitute permanent establishment and used to go out of the taxable net. So what India did it actually, so they did the same thing. They said, no way, any splitting of the contract with certain threshold, which we'll just hear from the panelists basically, they say if it is done in such fashion, it will be aggregated, or you can say it will be subject to tax and you will create a P even if you work less than the threshold which is provided in the treaty basically. Again, I get baffled all the time. I have Andrew from OECD, I see Grace all the time in front of me actually, basically. You know, I'm really baffled. I must tell OECD for that. Sorry for being like that. When so many countries do not agree with this, so many countries says, I make a reservation on that. So actually the whole concept of bilateral, I'm not saying it's difficult, so much of work has been done on it, and I know the entire edifice of OECD has been bilateral in nature. So it makes the exercise weaken it up actually. India doesn't do anything. India says, fine, I'm going to treat it. My corresponding country says, no, I don't agree, I'm happy the way it is. I'm not going to change my treaty. It's not a part of my MLI. So this clause in my country, as India believed it, I could have taxed that business of that country. I cannot tax it because the other country has not done it. Or maybe the tax credit, all those issues will come. So here comes again, sir, this clause, I know in India has been also highly used or misused. I don't know why I'm using it again and again. Basically, I want to understand, sir, this basically. Some cases I want to understand more in detail, basically, how the splitting was being done, how the revenue was actually losing the taxes or not able to collect the taxes, basically, and how this MLI, this clause, will be effective, actually.
The, the anti-splitting provisions, it's triggered when you have a timeline, like say in case of construction fees, supervision fees, installation fees, which has a typical timeline OECD model for 12 months. In most of our TTGs, I think it is 6 months. So OECD commentary itself suggests that this can be abused. I think if you look at commentary to Article 5, it says that for the contractors working, or the subcontractors working on the continental shelf for exploration of oil, they used to abuse it. You do it sometime, then you go away, then come back and do it in some other enterprise's name. So you don't meet that 12-month threshold. Or it also gives an example in Article 29.9, where it says that you put up a power project which requires 22 months, but what you do is you split it between two parties, related parties, just create a related party in that country and split to 11 and 11 months, and then it is out of the PE. Now, some OECD countries do believe that Article 29.9 gives them the necessary authority or the necessary way to target this abusive behavior. They can take it as that its purpose is abuse. So they thought that the changes may not be necessary. But we have faced this problem in the country. This is attempt to split the time between related enterprises. And so that's why we thought it's a very good progress, and that's why we have opted in all countries. And here it will apply to closely related enterprises. I think the OECD's longest project ran from 90 to 99 to almost 2010, resulting in authorized OECD approach, which made the PE virtually a subsidiary in the Article 7. But the next project, the BEPS 1, has to some extent made subsidiaries as PE with these changes. But as Mr. Nangia, you have been referring to, MLI, as I always say, that the most and perhaps the only argument in favor of MLI that why it is multilateral is perhaps only in its name. It is called multilateral. There is nothing much multilateral about it. It's actually a bilateral instrument. Unless the countries agree, nothing happens, and that respects the sovereign positions of the country. We cannot force countries to change their treaties. So that's it is an instrument actually. It helps countries to change treaties bilaterally. But it's end of the day, it's a bilateral product.
So can I say that BEPS 1 will not be, in spite of so much exercise, will not be able to, we have been discussing so many things and bilateral in nature, will it be meets its requirement in terms of taxing these things, what we have been reading right now, where other countries are not agreeing on it? What happens? Do you will have BEPS 2 after some years?
No, we already have, we are having, I think,
I've
BEPS
just
2
thought
in
about it.
digital
Can we have a BEPS 2?
debate.
BEPS
No.
1 will not meet the requirements. This is what I believe it actually. I think I have a OECD, but he says yes.
No, but
He
the
says-
most important result of this MLI or the BEPS project is, I think, the mainstreaming of the discussion on international tax rules, or the limitation of international tax rules, or the avoidance of taxes by the multinational enterprises. That has become the mainstream discussion. That has become discussion where the stakeholders are taking increasing interest, whether it is the civil society, the NGOs, the academia, or the political leadership. That is quite critical. I think, as Andy was referring, the OECD referred that we have maybe an estimate of revenue loss of 100 billion to 240 billion. I think IMF had come out with an estimate, I think maybe last year, which says that OECD countries are losing around 400 billion in corporate tax and developing countries are losing around 200 billion in corporate tax. It's quite difficult to estimate in any case, but that's the extent. So I think what has happened is, as we are discussing in Pillar 2, it's in public domain. We started DTA, Double Taxation Avoidance Agreement. Purpose was to avoid double taxation. Then we went to this BEPS 1, which in the preamble says the purpose is to ensure there is no double non-taxation.
Yep.
Now we have moved to Pillar 2, which we are talking, there has to be a minimum taxation. I think that is the way we are moving from ensuring no double taxation to ensuring some taxation to now ensuring minimum taxation. That is where the global thinking, that is where the international debate is moving on, and that's the major result out of this best process.
Neha, can you tell me that since different countries had reservations and what happens, the pre-BEPS position and post-BEPS position in such countries remain same? How do you deal with those countries?
So as I understand, Andrew also highlighted that many OECD countries don't believe that P threshold has to be, is an abuse, P is an abuse, and it can be taken care of by 29. That is, the principal purpose test can take care of the treaty abuse. But I have a feeling that by not accepting the P changes, most of the countries have restricted India's taxing rights.
That's the main thing.
And if you say PPT can take care of this treaty abuse, I have a serious reservation here that PPT has an exception to it. If the intent of the article is to provide or grant that treaty benefit, then it cannot be restricted by PPT. So if I say my P definition is restricted and it's giving me a treaty benefit under that article, how can you go on and tax me under a broader rule of PPT saying that now I can tax you because it is somehow a treaty abuse for me?
Before Andrew, you reply to her, add both the questions. I'm asking one reservation. You use different article and try to meet the requirements by this thing. And she's right in our thought, limited knowledge actually. Then it means that you're using some third diluted clause or try to take under that cover, okay, we'll tax you under that. But not on the direct to direct. Why not? You wanted to amend that article. Why you want to use principal purpose tax and leave the doors open for litigation? Sorry, this is my thought.
Well, just on that narrow point about the anti-contract splitting rule, when we were devising it during the BEPS process between 2013 and 2015, you didn't have any country sitting around that table saying, I'm in favour of contract splitting. I want my enterprises to be able to, split their contracts and avoid permanent establishments in the host state. No one was saying that. Everybody thought this was an abuse. And the reason that we developed the contract splitting, the anti-contract splitting rule, was mainly at the time because we weren't sure how many people would introduce the principal purpose test. This was at a time when we were developing the minimum standards and the approaches to treaty shopping, and we had the limitation on benefits rule and the principal purpose test. Now, the limitation on benefits rule does not address contract splitting, nor do the anti-conduit rules, which people might put in their treaty, but the principal purpose test does. So we were quite clear. We put it in the commentary that the majority of countries felt that if you had the PPT, there was no need for the anti-contract splitting rule. And indeed, there could even be a slight danger, because you're sort of admitting that the PPT is not apt to cover that sort of situation. And that wasn't a message that countries wanted to send. They wanted to send a strong message, and it's there in the commentary, that if if there's contract splitting going on, the PPT can attack it. And there's an example in the commentary that explains that.
So we agree that anti-splitting happens, like splitting of contract is happening. We accept that fact. And we want to cover it only through PPT instead of making a change when it was available. The option was available to change the definition of PE and bring it into the law transparently that yes, if you're splitting a contract, then you will constitute a PE. And more so, what could constitute preparatory and auxiliary 10 years ago or 15 years ago may not constitute preparatory now. The business models have evolved drastically. So those things have changed the picture of market jurisdiction as such. So market has become a nexus. As we all know, it's live, and we have to accept that market should have a taxing right.
Well,
And countries like India specifically, in the developing nations, they need their taxes, right?
Yes.
The countries that have made reservations are all those developed nations where they feel that these kind of activities should not constitute P.
okay, I mean, I think you've kind of gone beyond what we thought we were doing in the BEPS 1 and in the MLI, and that's kind of a separate subject. But bringing us back to what we were doing, and just picking up one remark you made, and I agree with this, things are moving very rapidly, and different sorts of abuse will emerge. But that indeed is a reason why you don't necessarily want to have a black letter rule that attacks that sort of abuse, but you leave it to the principal purpose test, which is a much wider conception. And as new avoidance strategies come to light, you're much more able to apply the PPT if you don't have black letter rules attacking a particular abuse that might have been there last Tuesday.
Okay, I think we need to go because we'll spend all the time in one article actually. And Navin, before I end up this article, as a business asset, I think this is for everybody. There's no grandfathering of this in this article. I'm doing a job, 31st of March 2020, everything is fine. On 1st April 2020, you invoke this article, I get taxable. So there's no grandfathering. I think when you have grandfather, you continue, I have factored taxes, I'm not subject tax. Next day you say, oh, in the same contract, same people, same everything. You tax me next day. I think something like grandfathering should have been considered actually. This is very expected actually. You can't tax me next day, change my whole business decision and my whole economics of business actually. Navin, from business point of view, doing a job like this, something happens to you, what happens then? You pay taxes the next day?
No, very fair point, Rakesh, and I totally agree to what you're saying. But the way I look at it here is that normally all the contracts have change of law clauses, and when because of the law changes, you're subject to tax, then the cost comes to the person who's buying, because this is normally passed on. Now, as a country who's very focused on the infrastructure projects, how much rigor we want to have, to implement this is again a more of a policy question. Given that it will become the cost of the Indian companies and the tax rate for foreign companies being high as compared to domestic companies in developed world, some of that credit may not be available.
I think when we move to, and basically when you see MLI, one of some mandatory things is the minimum standards actually. So before you implement any article of MLI, there are certain minimum standards which are non-negotiable. Basically, they have to be accepted. They're applicable on you. So all the MLI includes that. And the basic aim is to ensuring that a minimum level of protection against treaty shopping arrangements takes place. So minimum standards have been prescribed there. So each country can also opt out of MLI, either partly or entirely, provided it should not be a minimum standard. Even in respect of certain minimum standards, you have a flexibility, but you need to have this as a part of an MLI. And I'll just run it over. What are the minimum standards? The first is, what is the purpose of the covered tax agreement? Now, one of the purpose says Article 6 provides the preamble language of the CTA, which is to ensure that the minimum standards consisting of expressing the common intention to eliminate double taxation without creating any opportunities for non-taxation or reduce taxation through tax evasion or avoidance, including tax treaty shopping arrangements. So this is the minimum things which needs to be part of the preamble. India accepted it. I think it's a very fair thing not to accept these things, and they should be part of preamble. So it is the minimum standard which India accepted it actually. One other thing was principal purpose trust. Neha, can you just take it over? Speak on principal purpose test.
Yeah, so principal purpose test is a test which everyone has to go through because it's a bare minimum standard. So there were three options for treaty abuse given. Like either you can choose PPT alone, or a country could choose PPT plus a simplified limitation of benefit clause, or the most detailed one, which is a detailed limitation of benefit clause. These are the three options that you had when you are deciding the minimum standard for prevention of treaty abuse. So India has chosen PPT plus SLOB. As always, India is aggressive in taking the best position possible for its country. So in this case, it's that the treaty benefit can be denied if one of the principal purposes of entering into a transaction or an arrangement is to avoid taxes. So then the treaty benefit can be denied. However, it gives you an exception. If the granting of such benefit was the purpose of that article under which you are claiming the benefit, then this treaty benefit cannot be denied. So this is what PPT.
So this is also a minimum standard.
Absolutely.
So I think, David, I want to understand basically when 89 countries negotiate the treaties, so you have to agree, all they have to agree on these minimum standards. Did you find any OECD was unanimously to agree on this three minimum standard was really a tough thing? Because half of the 80% of the places we have reservations, fortunately, this clause had not agreed on it. And the related part is very important for me. The maximum dispute which I said in the first part is the permanent establishment. Why did you not make permanent establishment as a minimum standard? Majority of the things would have been over actually. You have to meet the P abuse as a minimum standard. I'm sure we would have killed the litigation. More. I'm sorry, this is my thought, Andrew.
Well, I think the last thing we would have done is kill the litigation. I think introducing the P changes as a minimum standard and putting all that in all the treaties, I'm convinced that leaving aside its merits or otherwise, it would not have decreased litigation. But to come to your question, was it difficult? No, it wasn't difficult, because no one was sitting around that table saying treaty abuse is a good thing. Everyone agreed that treaty abuse was, by definition, a bad thing, and had to be stopped. I mean, that was a common element. So to make that a element of the minimum standard, that wasn't difficult. But there was simply no agreement about making other things parts of the minimum standard. And for the Article 5 stuff, and we've already discussed that some things are more in the nature of a higher threshold or a lower threshold, which is not necessarily related to abuse. So there simply weren't the votes there round the table to make some of the other things minimum standards. Even India, which has taken pretty much everything, had a reservation on the transparent entity provision, for example.
So one of the things, sir, for you, sir, is MAP minimum standards and the dispute resolution MAP has been. We want to hear something. How is likely to expedite less litigation, more resolution, this MAP provisions in MLI, sir? A little update to our audience, sir.
No, as I said earlier, MAP was there in most of our treaties. MAP is a minimum standard, and it was in any case there. Now there is a time limit when you can invoke MAP within 3 years. But what has happened along with MLI is you have a MAP forum where there is a strict peer review process. So all jurisdictions are reviewing each other. So there is an pressure, or there is an obligation to conclude MAP within 24 months as quickly as possible on the competent authority. And that is being reviewed by our peers. Like we review our peers in the sense that what our major MAP inventory, which naturally with United States, United Kingdom, and most European countries, apart from Japan, Australia, and Korea. So I think after the map has become minimum standard, with the map forum review that is taking place year after year, and we are in the process, of course, coming out with a detailed map guidelines, which we are required to. Our review was just conducted and the report is out. So I think with this peer review process, all jurisdictions will be obligated to ensure that the map resolution are arrived at quickly, and that's why I strongly encourage that all taxpayers must consider the map forum, that is the map as an instrument for resolution of the disputes. It's you have this is an additional dispute resolution mechanism available to you. Your right under domestic law of going through the legal process or appellate process, that is there, and the map resolution is not binding on you. It's up to you. Whatever the competent authorities decide to resolve, if it is not acceptable to you, you still need not accept it and go on the appellate forum. So it's an additional choice, an additional forum available. I think that I personally see the way the map resolutions are happening now, particularly with my experience of as a competent authority for India with the Western Europe, US and UK, the way our resolution process is now getting speedier. I think all taxpayers must have a serious look at invoking MAP. I think that is going to be one of the most important way of, I think, resolution of cross-border tax disputes.
And do the final question. Post 1/4/2020, what do you foresee the challenges in implementation of MLI? Or more work to be done by OECD in any way?
I think I just want to maybe echo the answer that I gave in this morning's panel to the pretty much the same question, that you know, to the extent that the organisation has its own sort of wishes, you know, we think the MLI is an amazing piece of work, and it's got great potential to modify these treaties. And a lot of the work's been done. I mean, the hard work's been done. You know, the ad hoc group has done its work. We have the MLI. We have experience of it. We can help, you know, jurisdictions as the Secretariat. We can help jurisdictions to, you know, to prepare for signature, to prepare their positions, to prepare their, you know, their reservations and choices, and we can help them through the ratification process. So we just hope that, you know, far more countries will sign up to this instrument.
Nevertheless, friends, let me tell you one thing, is this uniqueness of MLI is actually, it will one stroke is likely to amend more than 1,500 treaties out of close to 3,000 treaties actually, just by one stroke. Less irrespective of the open things which are still left, it is indeed revolutionary in nature. Otherwise, bilaterally, it would have never would have happened to amend so many treaties and protocols. So undoubtedly revolutionary in the complex tax world. The true impact of MLI, I still believe, is unlikely to be fully understood for many years. It would take years, in my opinion, to have a global consensus for international fiscal rules, eliminating double taxation, double non-taxation, and creating a new and efficient mechanism to resolve the dispute. The reason being that the flexibility that the entire OECD has given to you because of the bilateral nature actually, and the options, reservations that have given to you basically, it actually creates a web of additional complexities and a confusion. It's a mixed thing, it's a boon. Very difficult exercise, having 89 countries to sit down, still leaves so many things open-ended. The question comes, is the elephant still in the room or it will be out? Time will tell. Thank you.
Thank you. I think just one thing I would like to say that, you know, India has ratified MLI and it will be effective from 1st April 2020. And it will be our endeavor, and we are seriously engaged with all our partner jurisdictions, countries. We'll be putting up synthesized texts in respect of all treaties that is getting modified. So we already have put in some treaties and most are under finalization now. Maybe within by end of October or by November, all the treaties that is getting modified by India with others, in consultation with the competent authority of that country, will be putting up. You know, as it's very clear, the synthesized text has no strict legal value. It's only, it's a guidance. You have to read the treaty as well as the MLI together, but I think the synthesized text would help you to understand and appreciate what changes have taken place in the treaty. So that should be up in the website. It's already started. We have a small corner in the website, incometaxindia.gov.
Yeah, but don't visit that.
Where it is.
Visit taxsutra.com. Please. And we are bringing you all the updates. I have
Thank
just one
you.
request.
Sure.
Yeah,
Thank
please.
you.
No, don't. You didn't hear that website link.
Anyway, thank you everybody for patient hearing. Thank you everybody, the panelists.